Mortgage interest rates explode on the latest CPI read. That's a read of inflation. I'm going to tell you what happened this week about the inflation read, about mortgage rates, but more importantly, what's the future of mortgage rates? Could there be some good in this? So the good, the bad, the ugly when it comes to mortgage rates. Then I'm going to show you, stay tuned for the end of the video. I'm going to show you exactly what it looks like. 4.5%, 5.5%, 6.5%, 7.5% interest rates, how that affects your mortgage payment, and what you might want to think about when you're buying forward. Stay tuned. All right, jumping straight into it. Before I do, if you're here, please like, comment, subscribe to the channel. If you find this useful in any way, I'd love to hear about it. Leave your comment down below. Let me know what else you'd like me to cover. As a mortgage broker who's on the front lines day in and day out, I really enjoy making these videos because I think they're useful to folks out there that are paying attention to real estate and mortgage and that. So subscribe, do all the things. Into mortgage interest rates and the inflation report. This week, namely April 10th, we got March inflation readings, CPI. Came in hotter than expected, and mortgage rates to a certain extent. Mortgage rates moving on a rate basis more than 0.25% in rate in one day is not very common. I think when I looked at some data, it said like pre-COVID, because post-COVID, we got a bunch of big moving days. It only happens like once a decade, right? So Wednesday's move to mortgage rates, we went up about 0.29% on rate, is a humongous move. And I'll tell you why. I'll tell you what to expect in the future and give you my 2 cents there. But let's just first start with why. Mortgage interest rates are highly influenced by inflation. If inflation continues to run hot like it has in these last 3 reports, the Fed has come out and said it, and they're really, really clear. They're not going to do anything to cut the Fed funds rate, which is going to affect not only mortgage rates, but credit card rates and all kinds of, car loans and other things, right? So the consumer price index, it's a measure of inflation. It came in up 0.4% month on month and up 3.5% year on year. The funny part is it wasn't that much far off projections. The projections were that it was going to be up 3.4% year on year, and we came in 3.5. So it didn't blow it out of the water, but still, I think it was enough. And it was the fact that it was 3 straight hot readings, high readings, that the reaction was a strong one in the mortgage-backed securities market, mortgage rates. And so after 2 months of hotter than expected inflation data, that we got in March and February for January, February, the Fed is just going to continue to talk about, well, maybe we don't need to cut in June or July. Maybe it might not be until September's meeting, right? And you'll start to hear this stuff. This is what economists and people that are paying attention to rates are paying attention to, is what is the Fed saying? It used to be that people were talking about 5 or 6 rate cuts in 2024. Then they were talking about 3 up until this latest report. Now they're talking about 2. And for anybody who's into stats, I think the numbers for a June rate cut were revised, and that is sub 20%. A July rate cut is now sub 50% that we get a cut at or before the July meeting. So interest rates are going to be higher for longer. That's what you should just count on, because the Fed is not going to do anything if they continue to see higher inflation numbers and strong job market numbers. And I won't go into the job market and all the things going on there, but all the data that continues to come out on unemployment in the job market shows strength in the job market, and continued high numbers in inflation. Both provide upward pressure on mortgage interest rates. And I'll show you, let me pull this up because people like to see exactly where we're at. And so the blue line is the average for the 30-year fixed. This is probably, when I look at this and I look at what's out there, pricing different lenders, probably comes at a cost. It's probably, going to be higher than this if you're sub 740 credit score, but it gives you a good average. That's all you need to know. And off of this peak of over 8%, we saw a quick blip last October. Rates had come down quite a bit, and we had been steadily at or below 7% for most of 2024. And then what you saw on the 10th was this big ping up from 7.06 for an average on April 9th to boom. Where'd it go? 7.34. So that's over 0.25% on interest rate. Not to mention if your credit isn't great, or if you don't have money to do any sort of buy down. Because quite honestly, if you've got a 760 credit score, to get 7 and 3/8, if you're putting 5% down or something, you're probably going to be paying a 0.5 point to a point for this interest rate. But that's neither here nor there. What I think is the important part is, how is this going to affect buyers, and how is it going to affect the housing market? First and foremost, before I show you just what I think is useful to look at, 4.5, 5.5, 6.5, 7% interest rate, and what that does to payment, is it's been long enough and enough data just over the last year. You see, we go up above 7, down below 7, up to 8, down to almost 6.5. I can tell you with absolute certainty that mortgage interest rates have an effect on buyer demand. Buyer demand will come down because of this latest uptick in mortgage rate, not just because people won't qualify, which some of them won't, right? Some of them that were pre-approved to buy something for $500,000 with 5% down are going to have to go back and look, well, rates are a little bit higher. Maybe now I only qualify for up to 480. Maybe they can get some funds. They could buy the rate down and they can still qualify for that 500. But there's going to be some that aren't able and they don't qualify. There's going to be a large cohort that aren't willing, meaning they qualify, but they say a $4,600 mortgage payment ain't it. I don't want to do that, right? And so with some demand pulled out of the market, what happens in real estate is a lot what I saw last fall and the fall before. Buyers will start to get a little bit of leverage. And as inventory climbs and more inventory sits, you're going to, as a buyer, be able to negotiate a little more. Now, trust me, going up 0.25% in interest rate doesn't change the whole equation, doesn't make it go from a market that's getting 8 to 10 offers on a house to a buyer being able to call the shots, offer below list, get seller concessions and all that stuff. But it swings the pendulum in that direction. So that is something that is positive for home buyers. It's quite honestly a good thing if you're not somebody who's thinking about just today and how to time it to where I get the best interest rate and the best price and all this stuff. Buy the home that fits your goals and your budget. Worry about getting, the best interest rate and dialing it in from a monthly payment perspective as a secondary thing. And I don't know if that came across how I wanted it to. Timing the real estate market is extremely difficult. So I don't recommend anybody do it. Take a look at the market, where it's at, where you're at, and just ask yourself, at this price, at this interest rate, is it something I'm comfortable with? And that's when you're ready. It's not when the market is doing certain things and there's, fire sales on homes or the interest rates tend to align. Like, that's an impossible task. So don't do that. All right. One last thing before I go, because I think this is important. I think this will be helpful for folks. I'm going to add this Excel spreadsheet just to show you, because people, interest rates are up, interest rates are down. What does that mean from a numbers perspective? What we've got here is a $500,000 purchase with 10% down and 4.5%, 5.5%, 6.5%, and 7.5% interest rate. For a lot of people, they're like, oh, rates are up. My payment might be $100 more a month, not realizing even at a $500,000 purchase price, which might be the median purchase price for home buyers in a lot of areas, it's significant what it does to your payment. Because you'll buy at 500,000, property taxes still the same, homeowners insurance still the same, mortgage insurance that doesn't change, but the interest rate from 4.5 to 7.5 is almost a $900 difference in payment. And so if I make this a little bit bigger, hopefully you guys can see this on the screen. An exercise that I like to do, just so that people aren't dead set on, I'm going to wait until rates go from 7.5 to 5.5, and then I'm going to buy, is we look at it and we say at 500,000 at 7.5% interest rate, your payment is $3,802 a month. Now, for some people, they're going to look at that and they're going to say, we make $14,000. We've got very little debt. $3,800 a month is a housing payment. That's something that's, reasonable and something that we can afford, and they move forward. If in a circumstance down the road, you can refinance and lower your interest rate and lower your payment, great. But it's not something that you're, unqualified for, or in this current moment, it still works, right? So, what people mistakenly do is say, you know what, I'm going to wait until that interest rate is 5.5, and I'm going to buy that house for 500 grand because I want this 3211 payment. The problem is if you wait until the rates go to 5.5, one, it might be a lot longer than most people expected. Two, if that is 24 months from now and rates go to 5.5, and a lot of this sideline demand, a lot of people that press pause now all come back into the market, and that $500,000 house now costs you $580. $580 makes that payment $3,725. So some might argue, and again, this is just to show you the numbers to give you something to think about. I'm not telling you what you could or should do. What some might say is, I don't want to wait until this house costs 580 grand. I'm going to buy it at 500. If I buy it here and I've got a payment of 3,802, maybe in 2 years' time, when the payment goes to 5.5 and I refinance it, now I've got a $3,200 payment. And again, this is rough math, right? I'm not factoring in like you might have paid it down a little bit, so it might even be lower than that on how much you owe, but just something to think about. There is some credence to the people that we talked to in Q4 of 23 and Q4 of 22 that went out there and got themselves a great deal on the house. The interest rate wasn't the greatest because, like we saw, rates went over 8% last October. Well, when they refinance and they were able to get that house at 480 that probably sells this spring for 540, they're refinancing it to a lower rate and getting a better deal on their overall payment, which is important to everybody. So, all right, got more long-winded than I wanted, but rates are going to be higher for longer. That's the thing we're hearing, and it's a matter of looking at your specific scenario, not waiting for this Goldilocks scenario where home prices and rates are at the perfect spot for you. So thanks for watching. If you made it this far, bless you. 14 minutes in. What the heck was I talking about?